You're listening to the Financial Source podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome to the Deep Dive. Today we're really trying to cut through all the static, we'll give you the key signals from global finance, trade, geopolitics. What we're seeing is this fascinating friction point, a real tug of war, between very specific local central bank moves on one side and just this huge wave of global political uncertainty on the other.
Exactly. And our mission here is to unpack the latest sources, currencies, commodities, political risk, and find those connections, maybe the surprising ones. We want you to walk away understanding not just what's happening, but maybe why these specific bits of data are moving markets right now.
Yeah, and the starting point is, it's a total paradox, really. It kind of defines the moment. You've got the dollar index, the DXY, holding firm, showing broad strength. This is happening even with all the U.S. domestic chaos, right? The government shutdown is still dragging on. But then you contrast that strength with just major volatility out of the Pacific, really hitting the Japanese yen and the Kiwi dollar hard.
It's pure risk aversion playing out, isn't it? And that's where we have to start. So segment one, these currency surprises. And you really can't talk volatility without looking at New Zealand. The sources show a major move from the RBNZ, the Reserve Bank there.
It was more than just a standard move, wasn't it? It felt like a statement. They cut the official cash rate by a huge 50 basis points. That brings it down to 2.57%.
Yeah.
And usually you see 25 points, right?
Yeah.
So this is like a double shot, almost signaling, well, maybe not panic, but real concern.
That 50 basis points, that's the key number. It was unambiguously dovish. And when we say dovish, we mean the central bank is clearly focused on stimulating things, Lower rates, signaling they're ready to ease policy, maybe aggressively. And the RBNZ didn't just cut. They explicitly said, the door's open for more easing later.
Wow.
The market reaction, instant. The NZD, the Kiwi, got slammed right to the bottom of the G10 currency pack. It just shows how powerful one decisive central bank move can be.
Okay, so New Zealand, aggressively dovish because of their own economy. But the yen, that pressure seems more about weak data coming in, right? We saw softer wage data out of Japan recently, and that seemed to help keep USD JPY above that key 152 level.
Yeah, and that 152 mark is worth pausing on. It's not just some random number. It's a big psychological line in the sand, technically too. Once the yen weakens past that against the dollar, everyone starts thinking about intervention from Tokyo. And okay, the Bank of Japan hasn't moved yet, but officials are definitely on alert. They keep saying they're watching for excessive or disorderly moves, this constant tightrope walk, trying to stop the yen sliding too fast.
Right, and they're shifting over to Europe. The euro's feeling pressure too, but from something totally different, it seems. More like political risk.
Precisely. It's that lingering French political uncertainty. The sources got pretty specific. You had national rally leaders refusing talks proposed by the outgoing prime minister. That just throws more instability into the mix. President Macron's apparently pushing for, last-ditch efforts to stabilize things. The euro is always super sensitive to political cracks appearing between its big members. So this kind of gridlock is a real headwind for the currency.
Okay, so now let's loop back to that paradox we started with, the strong U.S. dollar. The DXY keeps climbing despite all this domestic noise, the shutdown, the White House even mentioning potential federal job cuts.
Yeah.
How does that work? Why is the dollar a haven when its own house seems, a bit messy?
Well, it really says a lot about the lack of other credible options right now, doesn't it? That DXY strength isn't necessarily a thumbs up for U.S. policy. It's more a reflection of instability elsewhere. The political risk in Europe, the big RBNZ easing, general geopolitical stuff. When global fear ticks up, money flows into the deepest, most liquid market. And that's still the U.S. dollar.
The default parking spot.
Exactly. And sterling, the British pound, it's basically just tracking that broader dollar strength. It underscores that the DXY is kind of the main story right now, even overriding U.S. domestic worries for the moment.
Okay, that makes sense. So if currencies are reflecting political risk, let's look at the purest risk barometer. Gold. That's where the haven demand should be obvious.
And it was. We saw gold push higher, confirming that this flight to safety is definitely happening.
Yeah, the sources showed spot gold hitting multi-session highs before pulling back just a bit, and the whole move was driven by classic haven demand, right? Directly linked to all this policy noise and political uncertainty we've been talking about France, the U.S. shutdown.
Yeah.
When policymakers create uncertainty, gold tends to do well.
Now, moving over to energy. Oil's showing a little bit of firmness, and the reason why gives us a clue about future demand, not just today's supply.
Yeah, what's interesting there is the main driver wasn't like a sudden supply cut or anything. It was an updated forecast. The U.S. Energy Outlook actually raised its 2025 world demand forecast. That kind of suggests some underlying belief in a longer-term recovery, despite all the short-term political noise.
And we got some concrete numbers, too, to ground it. Regional producers updated their official selling prices. UAE's ADNOC set its November Murban benchmark at $70.22 a barrel. So that's a reference point.
Although for now, the market's still a bit cautious, right? The U.S. inventory data was mixed. Crude stocks actually went up, suggesting plenty of supply, but gasoline and distillate stocks fell. That mixed picture keeps traders guessing.
Yeah, keeps things range-bound. And just briefly on industrial metals like copper, much quieter. That slowdown is mostly because China's onshore markets were just trickling back after their long holiday. It reminds you how much those holidays can temporarily mute global industrial signals.
Okay, so putting that together, oil demand forecast looks optimistic longer term, but right now, trading is cautious because of inventories and, well, all the political stuff driving haven assets like gold, which takes us right into our next bit. Trade, tech, and tensions.
Yeah, and this is heavily dominated by high-level U.S. diplomacy, really focused on strategic competition.
That's the core of it. Washington announced the president plans to meet China's President Xi in a few weeks, and that meeting's set for South Korea. This is going to be huge for setting expectations around export controls, tariffs, the whole relationship.
But crucially, even before that meeting, we're seeing serious, organized pressure from inside the U.S. government for allies to get tougher, especially on tech transfer. This is where we get into the nitty-gritty of trade war mechanics.
Yeah, what's the specific demand? What's the committee asking for?
Well, a U.S. House committee was very clear. They're urging that Dutch and Japanese rules on semiconductor export curbs must match U.S. restrictions. They want consistency. They're basically arguing that unless countries like the Netherlands, home to key chip gear makers, adopt the same strict rules as the U.S., the whole strategy to limit China's access to advanced tech won't fully work.
And they want to cast a wider net, too, right, in terms of who's targeted.
Exactly. They also called for an expanded list of prohibited Chinese end users. It signals these tech restrictions are constantly broadening, covering more companies, potentially more sectors seen as security risks.
And there's another layer, too, telecom equipment.
Yeah, adding to this tech decoupling push, the FCC is getting ready for a big vote this month. It's aimed at further limiting Chinese telecom gear that's deemed a security risk. So you see this policy playing out across different agencies, not just semiconductors.
Okay, but on a more positive note, for trade closer to home, U.S.-Canada talks sounded pretty good, described as substantial. They specifically highlighted steel, aluminum, and energy as areas where agreement could happen soon. That signals maybe some stabilization, cooperation in North America, which is, a counterweight to the friction with China.
And we also got a couple of clarifications out of Europe on EU trade rules. Trade policies always have these tricky footnotes, don't they? Norway, for example, confirmed it's exempt from the Commission's proposed higher steel tariffs and lower quotas. Meanwhile, the UK was seeking urgent clarification on how those same EU rules might impact British industry. It just shows how fast these decisions ripple outwards.
Okay, finally, let's wrap with the big geopolitical flashpoints.
Yeah.
Because these risks are feeding directly back into things like gold and the dollar's haven appeal.
Starting with the Middle East, U.S. officials reviewed progress on the Gaza talks. Envoys are getting ready to head to Egypt. Local media were describing the latest round as positive. But there's still a fundamental sticking point slowing things down.
And what is that main hurdle?
Well, Hamas explicitly criticized parts of the U.S. framework, and they insisted that any deal has to fundamentally end the war and also address broader Palestinian demands. That demand linking any hostage release directly to a permanent end to the fighting, that remains the core issue that hasn't been resolved.
Okay. Shifting to Eastern Europe, the rhetoric seems to be heating up again, raising risks around borders and energy infrastructure.
Yeah, specifically, President Putin accused Ukraine of trying to strike deep into Russia, hitting civilian sites. That kind of language always ramps up the perceived risk of the conflict widening, puts markets on edge about energy supplies, regional stability, all of that.
And connecting this all back, we can't ignore the U.S. domestic situation. We started with the dollar paradox, but that federal shutdown just keeps going. And it's not just political theater, is it? It's delaying some planned economic support, even routine data.
Exactly. This ongoing domestic policy mess adds a real unnecessary layer of uncertainty to the global picture. Even if the dollar is currently shrugging it off, it's the kind of policy risk that could suddenly morph into a serious market risk.
So wrapping this all up, what does it mean for you trying to make sense of it? The synthesis seems to be we're in a market pulled in two directions. First, by these very localized, sometimes aggressive central bank moves like that RBNZ cut impacting the Kiwi. And second, by this big systemic global political chaos that's driving haven demand for gold and, weirdly, the strong U.S. dollar, which markets still see as the least bad option.
Absolutely. And there's a third, maybe longer-term theme, the intense focus on tech alignment between the U.S. and its allies. Those specific demands on Japan and the Netherlands about matching U.S. chip export rules. That's reshaping global trade in real time, zeroing in on strategic control over key tech.
So the key things to watch, they're pretty specific. First, keep a close eye on the yen and the Kiwi this week.
Yeah.
How did they behave after that weak wage data in the big RBNZ cut? That'll show if those moves are truly priced in. Second, watch if those high-level U.S.-China and U.S.-Canada talks actually lead to concrete changes on export controls or tariffs. Any sign of movement there, up or down, the market will react fast.
Which leaves us with a final thought, maybe something for you to mull over. Given that both gold and the dollar are reacting so strongly to all this political noise and instability, how might global markets react if that U.S. government shutdown keeps dragging on, delaying economic support? Could that persistent internal U.S. policy paralysis suddenly become a major trigger for international volatility? That's the real unknown hanging over everything right now.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.